Hey everyone, and welcome back to another Bitcoin and macro video. In today's video we're going to be discussing the most recent interest rate print, we're going to talk about the most recent unemployment rate print, and we're going to talk about the most recent inflation print. If you like this type of content, make sure you hit that like button, make sure you hit that subscribe button, as it means oh so much to me. And if you are a fan of cryptocurrency and you do want some help, you want to dissect my brain a little bit, I've put all the information onto a cryptocurrency course. You can see all of the fundamental values on this screen right now. It is only £26. I'll leave a link in the description down below so you can also get a nice discount off your next purchase. So without a further ado, let's begin. And I just wanna say quickly, I've been away for a couple of weeks. I spent some time with some family. I became a godfather. I christened my niece, and I also went away on a trip to Portugal for just over a week. I went to Lisbon for a couple of days, and then from Lisbon we went down to the south coast. We went down to the Algarve, Portimao, Lagos, Faro, all of that good stuff. I do recommend Portugal. The food there is amazing. I'm a big foodie, as I'm sure most of you guys are. The value for food is amazing. They're not stingy with their food, and it is high quality indeed. So I do recommend Portugal. But in today's video, we're going to be discussing the macro data because a lot has happened since I last made my last video. I was of the opinion that, and I'm still of the opinion, that we were either going to get a rate cut in June's meeting or in July's meeting. And I'm going to discuss the implications in comparison to the Bitcoin price in each scenario. So if we take a look at Bitcoin USD right now, I was of the opinion that if the Fed were to cut rates in June, then I believe that the Bitcoin USD price would have already topped out, where it topped out in March of this year. Whereas if the Fed decides to cut rates in July, then I believe Bitcoin USD still has time to make all-time highs and clear this region right here. Now, why do I say that? I'm going to get into that towards the end of this video, so make sure you stick around. But in the meantime, I'm just going to discuss some of the most recent macro prints, talk about interest rates, talk about the unemployment rate, and talk about the inflation rate. So, as we all know, the Fed decided to keep interest rates at 5.5%. And I dropped a TikTok the other day describing the scenario of what would happen. And someone commented on the video saying, well, what about other central banks like the European Central Bank cutting rates for the first time in June? And my answer to that is the Fed or the US economy is a lot stronger than any other economy in the world. They hold the most power, right? Now, when you compare the US economy to the European economy, you have to think that the European economy has so many countries that are struggling at the moment with these elevated rates, whereas the US economy can just strictly focus on their own economy. Yes, some states are currently struggling in comparison to other states. Like we all know that probably New York and Florida and California are probably doing better than other states. But with that being said, the US economy is a lot stronger than the European Central Bank. So therefore, the Fed can keep rates elevated higher for longer in comparison to other central banks. So that was my answer to that question as to why the Fed is still keeping rates elevated in comparison to other central banks looking to cut rates. I mean, I wouldn't even be surprised if the Bank of England decided to cut rates, whereas the US economy will keep them elevated. It's just how it works, guys. The stronger the economy, the more you can keep rates high for longer. And that also ties into inflation and unemployment. They all interlink. All of these macro prints, guys, they all interlink. Allow me to explain why. So, as we've just discussed, interest rates higher for longer. Why can the Fed keep interest rates higher for longer? Well, we do know that that stems from having a strong economy. But what does having a strong economy mean? Well, in times of elevated interest rates, the reason why interest rates are elevated in the first place is to control inflation. So if we take a look at inflation, And over the years, you can see, especially after the pandemic, inflation started to skyrocket to that 9% level. So the Fed decided, okay, we need to put a halt on inflation before inflation gets insanely out of control, because people are spending money like there's no tomorrow. Yeah. So what do? They elevate interest rates to control inflation. So you will see a negative correlation between inflation and interest rates. Whenever inflation goes up, interest rates are down. Whenever inflation goes down, interest rates are up. That is how the Fed controls inflation. Another thing when looking at the unemployment rate, however, and how it links to interest rates also has a positive correlation with the unemployment rate. As interest rates goes up, the unemployment rate also goes up. So there's a difference. Interest rates has a negative correlation with inflation, but has a positive correlation with the unemployment rate. And why is that? Well, you have to think, when the US economy raises interest rates, that puts pressure on the consumer, that puts pressure on businesses across the country, because businesses, the way they thrive is that they take out loans. When interest rates are at low percentages, that means money is cheaper. They'll pay back less on interest on their loans. So when interest rates are low, all the companies are borrowing money, expanding their balance sheet, etc. And people are thriving. Yeah, people are spending money. Even the consumer. The consumer has more money because there's more circulation going around. You know, they might be buying more holidays. They might be buying more goods. That's just how it works. I mean, just look at the pandemic. When the pandemic happened, everyone was spending their money. Stimulus checks were getting printed. Everyone was happy, right? On the inverse, when interest rates decide to go up, it tightens and constricts the economy. It takes that money and pulls it back out of the circulation. And we can look at this by looking at the US money supply. And you can see since the pandemic, the US money supply has decreased. And the US money supply has, again, a negative correlation with interest rates. Because if interest rates goes up, the money supply goes down. When looking at this, you have to think, okay, this is what happens when interest rates goes up. Inflation looks to come down, but the unemployment rate starts to go up. And that's where it can get tricky for the Fed. We're getting to that sticky point because inflation has fallen to 3.4%. That was the most recent print, 3.4%. So it has decreased significantly from 9%. But the Fed's target ultimately is 2%. So they're not at their target yet, which means they need to keep interest rates elevated enough to the point where inflation goes down to its goal of 2%. Here's the tricky part. Whilst you're trying to bring inflation down, the unemployment rate goes up, because we all know it has that positive correlation with the unemployment rate, but a negative correlation with inflation. Now, if the unemployment rate starts to go up, and it is currently at 4%, the US economy doesn't want a high unemployment rate, because they want a thriving economy. They want people to work within the economy. They don't want people laying on the streets being homeless and having a high unemployment rate. That just doesn't mean you have a thriving economy. It means you have a weak economy, an economy that's broken. You need to be very careful, and I say you, but the Fed needs to be very careful in what they do here, because if they keep interest rates higher for longer, that will spring them into a recession, because the unemployment rate will shoot up. And the unemployment rate is essentially the biggest signal which sparks a recession. And I was of the opinion that if we get a print above 4%, that is when the Fed will likely look to cut rates. And at the moment, a 4% was just printed. So 4% unemployment rate and a 3.4% inflation rate is starting to get a bit shaky, because what does the economy do next? The next Fed meeting is in 46 days, which is the 31st of July. The probability is leaning towards the Fed again keeping rates at 5.5%. And I'm of the opinion that the Fed is going to cut in July, and I still firmly believe so, because we get a lot of data at the beginning of the month for inflation, for unemployment, for everything else to do with the macro side of things. And if that comes out in July, I'm of the opinion that this is going to swing this percentage majorly. And this percentage, well, this outlook by market makers they always tend to get it right. I mean, if it's the day before the meeting and the probability is heavily on one side, it is more than likely going to be the case. Whereas now it's saying is essentially a 90% approval of keeping rates elevated at 5.5%. We still have 46 days left. This can easily shift once we get news of new macro data. Because let's say, for example, and this is if buts or maybes, but I'm going to give you both sides of the story. If we look at the case of the Fed looking to cut in July, that would essentially mean that inflation would have to come into the lower 3 points and the unemployment rate would have to go into the lower 4s. A print just above 4% is what would keep them occupied. But the thing is, the Fed cutting rates to 5.25% from 5.5% doesn't mean that quantitative easing is occurring. Yeah, it still means that quantitative tightening is taking place, but just at a slower rate. A lot of people get confused with this because they believe that cutting rates is essentially turning the money printer back on, but it's not. You're just dropping 0.25%, which still means that the economy is tightening and is still constricting, but just at a very marginal, slower rate. So I believe once we get that print above 4, inflation starts to trickle back down to the lower 3s, the Fed will be forced. And that is what will happen if we get those macro points in the beginning of July. On the other hand, if inflation starts to tick back up and the unemployment rate comes back down, then the Fed will be forced to keep rates elevated. That's just how it works. So how does all of this tie into Bitcoin? We know that Bitcoin is the king of cryptocurrency, and we know that altcoins essentially bend the knee to Bitcoin during these macro environments. This all has to do with the Bitcoin dominance, right? Because the Bitcoin dominance essentially measures Bitcoin's market cap in comparison to the market cap of every other cryptocurrency out there. And at the moment, the Bitcoin dominance is currently sitting at 55%. So it's currently more than everything else by 5%. And in these instances where we go through a rate hiking cycle, if I just overlay this with interest rates, you'll be able to see what I mean. And those who have watched my videos in the past, you'll know what I'm going to say. So by taking a look at Bitcoin's history, you can see that we've had a prior rate hiking cycle before. So you can see that the Fed started to increase rates in 2017 and 2018, and ultimately in the beginning of 2019, the Fed paused the rates, and then rate cuts happened in the second half of 2019, and then interest rates went to zero from the pandemic. How did Bitcoin USD react? And how did it react in comparison to the Bitcoin dominance? So we all know that during macro trying times, when interest rates goes up, liquidity from the higher risk assets flow into the lower risk assets due to uncertainty within the economy. So there's a very clear correlation here where interest rates goes up, Bitcoin dominance goes up, Bitcoin USD goes up. That's just how it works. If we take a look at this time, you can see again Bitcoin dominance going up from the increase in interest rates, which also results in Bitcoin USD going up. Where does that leave us on the short term, however? Because we are nearing the peak end of this rate hiking cycle. What does this mean? So I was of the opinion that Bitcoin USD still has time to put in new all-time highs. And why is that? Well, if we take a look at prior history, you can see that the very first rate cut, which essentially happened in July of 2019, Bitcoin peaked a month before the first rate cut, and that also coincided with the Bitcoin dominance shooting up. If we take a look at where we are today, if the Fed decides to cut in July, as I predict, Bitcoin has room of essentially 4 to 5 weeks of going and boosting up to the upside, which will also trickle in the Bitcoin dominance putting in its final top for this cycle. So why do I believe this? I believe this because if we take a look at altcoins in comparison to Bitcoin, there's still a lot of market share for Bitcoin to gain from these altcoins. You can see at this exact point where we are in the cycle, that is when altcoins broke down against Bitcoin. And if we now overlay this with Bitcoin USD, you can see that Bitcoin USD had its final rally towards the end of that rate hiking cycle. Just like where we are now, we're nearing towards the end of the rate hiking cycle. If rate cuts happen in the end of July, what happened? Altcoins bled against Bitcoin in the short term, just like they did last cycle. And they bled because Bitcoin went to the moon. Bitcoin sparked up like crazy and put in a mid-cycle high. I believe that it has time to put in a new all-time high this cycle, especially if it gains market share from all the other altcoins. That is where I am in the short term of Bitcoin. I believe Bitcoin can hit a new all-time high, especially if the Fed cuts in July. There's more than enough time to do so. If not, it will just kick the can down the road, and then whenever the next rate cut occurs, Bitcoin still has time to put in new highs. So that is it from me today, guys. I hope you all enjoyed the video. If you did, smash that thumbs up, smash that like button, and as always, it's been your boy J1 General. Thank you and goodbye.